Welcome back to the channel. My name is Brad. Today we're going to talk about SVOL and its most recent battle with the VIX. What is SVOL? SVOL is trying to short the VIX. It's shorting the VIX by 20 to 30% short exposure on the VIX futures. So what's the VIX? The VIX is the SVOL volatility index. It represents the market's expectations of equity over the next 30 days. Investors consider this to be the measurement of the stock market fear or stress. So what happened to SVOL and the VIX the other day? Well, on August 5th, SVOL had a huge price dip due to the VIX spiking. The VIX spiked due to some market conditions over in Japan that impacted us here in the United States also. Since this, the VIX has come back down, and SVOL has actually totally recovered, or almost recovered, to exactly where it was before. So what does SVOL have as holdings? SVOL has several ETFs in their holdings that they actually also manage. This makes up a significant portion of their actual holdings. They have AGGH, BUCK, CDX, HIGH, and MTBA. All right, this combined total is almost 40% of the actual holdings. These are all high yielding ETFs that they hold in the fund so they can write the calls against the VIX. They also have future contracts. They're dated out several months in advance. Right now they hold September and they hold October. At the same time, they actually have the VIX over 50. This is the security blanket. If the VIX goes over 50 and holds for a long period of time during a market crash, this is the security blanket that will help SVOL survive and not have huge price depreciation. Also, you'll notice that they're actually shorting the market right now. Small percentages, very small percentages, but this is also another hedge. They're proactively making sure our money doesn't dissipate if a VIX big spike happens again. So how does the VIX actually make money? VIX makes money by taking the VIX futures and buying several months out and riding it left to right. Well, how do we know this is how it's going to be? Well, generally speaking, the market is what they consider to be in contango. So it's always going from left to right and sloping upwards. When they buy, right, they get paid a premium, a higher premium than when they go to roll it. So what will happen is they will, in this example, they will buy at 40 and roll approximately 25 and make that 15 difference and roll it back to 40 and make that differential between the two. This is normally how the market works 85% of the time. When does it not work is what they call backwardation. When the futures of today is worth more than the futures in the future. The future contracts, because the future contracts in the future are worth less than what you hold, and now you have a loss. So now let's look at SVOL's pricing over the last 3 years. So the price of SVOL actually, total return, is greater than the S&P 500 over the last 3 years. All right, that is amazing. It's another alternative ETF that probably should be in every investor's portfolio. A small percentage, but it should probably be in every investor's portfolio that is interested, one, in income, and two, in total returns. Because SVOL is actually another way of pricing the S&P 500. If you like this content, Please hit the like and subscribe, and we look forward to seeing you in the next video. So when we talk about SVOL, we talk about average yield. Right now, it's 16.2 is the average yield that we receive every single month. And you can see in 2023, the average yield was 17.19. That is a great yield on your money. This is, again, something that probably should be in everybody's portfolio. Well, we found out that the VIX is a very good ETF to hold for the long term, as this will have capital appreciation as well as extremely good dividends with the total returns. So it's good for both income investors and growth investors.